Hello, everybody. Now, to start with, let me say a word on the wording. When I speak of digital currency, I mean central bank digital currency, central bank issued, and I assume it will come as an account-based, as a conventional account-based solution, which does not preclude that digital currency can be and is likely to be processed also by cryptographic technologies, distributed ledgers or howsoever. Now, I would like to take a more long-term view of digital currency. So far, we have heard many things about pros and cons and so on, but that was, so to say, a near-term view in my understanding, and a more long-term view. Taking a more long-term view, let me refer to a metaphor, and that is the metaphor of the tide. Ebb and flow, rising tide and ebb tide. And that's a metaphor, of course, but in this case it's grounded empirically, it's grounded in history. What you see here apparently is a rising tide. It goes more than 100 years back, and it's the rising tide of bank money. It started early in the 19th century, of course, but now it has reached close to between 95. So the actively 95% or even 99% of the public money supply. And in mirror image, what you can see here, the ebb tide during that time, that is the decline of central bank money in public use. And so this decline of cash, but what you cannot see here, and even more importantly, is in actual fact the decline of central bank reserves as an active means of payment. The need of large banks, the relative need for central bank reserves. So if that trend would go down to zero, it actually would mean that central banks risk becoming sort of King Lackland, kings without land. And so we have reached a point, and this tide change was actually the third we have experienced in modern times, because in modern history we had two such tide changes before, and the first was starting from the mid-1600s until the mid-1800s, and at the time the ebb tide was for sovereign coin, precious metal coin, and the rising tide was of banknotes at the time, mostly private banknotes. And then that tide was followed by, from the mid-1800s until the early 1900s, that was the ebb tide for private banknotes, and the rising tide of central bank legal tender notes, constituting the note monopoly such as it still stands today. And the third tide, I have just shown you the slides before, and as I think we are now entering, or very likely we already have entered into a new tide change, and that will be the ebb tide for bank money, the beginning, of course, and at the same time the rising tide of digital currency in whatsoever form. There might be a multitude of forms of digital currencies, but of course we are at the beginning of that tide change. And so that envisaged coexistence of digital currency side by side with bank money, complementing and also competing with each other. This will be, and already it's a dynamic process. It's not static. I do not think you can imagine we will have 10% digital currency and 90% still bank money. It won't work that way. It will be a very dynamic process, and the overall dynamic, according to that historical image of monetary tide changes in the composition of the money supply. So that clearly points in the direction of a a sovereign money system, which means the digital currency, in that sense, it's unrestricted legal tender, and that's of course sovereign money, very generally speaking. And what you can expect is that the more that process will take place, the more the problems of the bank money regime of fractional reserve banking will recede step by step, and the more the advantages of sovereign digital currency will be experienced. I have to skip that and also that, because there was enough talk about the problems and the advantages and disadvantages. I skipped that. And so that the new path towards a digital currency, towards a sovereign money system, that path is not yet really established, and it's not self-evident that things will go in that direction. And you see, throughout the last 300 years, we always have had that conflicting and problematic constellation of so to say, state money and private money side by side. This has always been a problematic situation. And also now in the new case of digital currency coexisting side by side with bank money, so that the new direction of that path, that it cannot be taken for granted. Not only because there might be additional new challenges, such as, for example, money market fund shares or various sorts of e-money not based on digital currency or central bank reserve, but based on bank money. That's easily imaginable and already exists, of course. And so digital currency may not be the fast-selling proposition it is supposed to be. For example, imagine a situation where we have a business as usual, which normally is the case, and we do not normally have a crisis, but normally we do have business as usual. And banks will in that coexistence, banks are likely to pay some deposit interest on bank money, as many have done before. And while none or less interest is paid on digital currency, and at the same time, central banks and governments maintain those now often quoted far-reaching state guarantees for bank money. And under such conditions, one would not expect firms and private households to feel urged to switch accounts. And so it remains unclear from today whether a significant shift from bank money to digital currency would occur at all or would occur anytime soon. And whether or not that will happen, that exactly depends on, of course, on the way of how a digital currency is going to be implemented. It depends on the layout, so to say, of the system, or say the design principles of the system. And there are, of course, and you may have noticed already today, there are, of course, some design principles here put forth that are actually conflicting with each other. I myself, I have identified 10 design principles on which it depends whether or not such a new path towards, whether digital currency will in fact establish a new path towards a sovereign money system. I will now go briefly through these 10 principles, and no idea what's that. The first is that digital currency accounts or mobile digital currency media, they ought to be provided according to market demand. They should not be limited, so there should be no restrictions regarding access of actor groups. For example, there was the question of retail banking versus wholesale banking. And for example, just a possibility, should retail banking be excluded, then I think the entire enterprise would be pointless from the beginning. it makes sense when the entire public is included. So digital currency is thought to be, rightly thought to be, is thought to an instrument of monetary and financial inclusion. And I didn't tell you that idea. Well, number two is that the digital currency and interbank reserves ought to be merged into one circuit. That's not self-evident, and why do I think that? The reason is that conventional interbank circuit reserves and digital currency in public use, as a means of payment, they represent the same sort of money, the same type of money with the same properties of the same nature, and so I think that central bank and digital currencies belong quite naturally in one and the same circuit. And that would be real progress, and I see no reason why to create two artificially separated or segregated circuits when it's one and the same type of money. Apropos inclusion. Now, the next principle is full convertibility between bank money and digital currency at any time, at any amount, because otherwise, if that principle does not apply, there are two risks. And the first is that the one-to-one parity between bank money, bank deposit money, and digital currency that might come under pressure. Now, that's the first risk. And the second risk is, so the much quoted, the bank run scenario that might actually be triggered if this is not guaranteed. And for the same reason, the next principle, number 4, I don't know how that came about, so this flying in, I didn't want to have that. The next principle is, some of you will of course object, but taking a long-term view, there should be no restrictions on the quantities of digital currency. Not only no restrictions on access to digital currency accounts, but also basically no restrictions on the amounts of digital currency available. Because otherwise, again, there are these, if this is not fulfilled, these are again these two basic risks of the one-to-one parity between these monies coming under pressure, and so the bank run scenario. For example, the E-krona concept, it does not put a ceiling on the quantities of money, not expressly so, but it wants to apply present cash payment limits to the E-krona. And this, of course, is tantamount to, in actual fact, putting a ceiling on the quantities of available digital currency. I mean, in a way, I can understand that central bankers, it has often been said today, are prudent. They tend to be prudent and rather conservative. And so they first will try, let's start with a certain amount and so on. But I mean, in the long run, certainly that such limitations on available quantities should be lifted, and so step by step such limitations should be removed altogether. Following from the fourth principle now, this is the fifth one, and this is actually, and you have discussed in the round before, you have already discussed that problem, a conversion guarantee by the central bank, particularly in a bank run situation. You see, in the present bank money regime, the bank run problem that always exists is much played down. And while, interestingly, when discussing digital currency, it is much exaggerated, but we don't have a bank run every day. We have a bank run only in a situation of crisis. And let me stress one thing. The bank run problem is a problem. It's a serious problem. But what is it more precisely speaking? It is the problem of bank liquidity under conditions of fractional reserve banking. So the bank run problem is a problem of the existing monetary regime. It's a problem of bank money. It's not a problem of digital currency. That should be seen. It's treated as if it were a problem of digital currency. No, we have had that before. We have that coexistence of cash with bank money. No, and that will continue to be the case. And so I think the best method of dealing with that problem is really to give that central bank conversion guarantee. And in fact, I think this is the ultimate answer to the problem. And imagine yourself, if you know you have a central bank guarantee that in case of, you can anytime convert your bank money into digital currency. I think that most of us will not necessarily do it, because if we have the guarantee, there will be no panic. And so I think that's also an instrument of preempting. Now the sixth point is that those famous state guarantees for bank money. We know that the bank money regime would have long since collapsed without ready central bank support, state guarantees for bank money, a government bail for banks, now by the way also including forced customer bail-in. All these are auxiliary constructions maintaining the inherently very unsafe and unstable bank money regime. And I think that when introducing digital currency, the more digital currency will be introduced, the more the state and central bank guarantees can be reduced and finally removed. Yes, public bodies, as soon as there is digital currency, public bodies should immediately start using digital currency. Of course, also step by step, not overnight, changing accounts, all the accounts, but step by step, because you see the absurd situation today is that state bodies, for example, the tax office, they want to be paid in bank money. They refuse to be paid in cash. I mean, understandably for practical reasons, but what it means is state bodies refuse to be paid in the state's own money, and they want to be paid in the bank's private means of payments. That's absurd, and digital currency actually allows to correct these things. I have now the eighth principle. This is the question of should there be interest on digital currency or not. And I would say, as Senor Ordonez has said, that money in the sense of the means of payment itself, that should not be interest-bearing. Why should money be interest-bearing? And the assumption that money is interest-bearing, that rests on the present very close tie between money and credit, even outright confusion of money and credit. And so credit is, of course, interest-bearing, or it should be. Money itself, so the means of payment, should not be interest-bearing. But pragmatically speaking, as I said, in a situation when there is digital currency, banks are very likely to pay some more or less decent deposit interest. And in this situation, the central bank ought to pay the same rate of interest on digital currency in order to create a level playing field in the competition between these two monies, because otherwise we would have a very undesirable pro-cyclical shift back and forth. So in times of business as usual, into bank money because it's interest-bearing, and central bank money would not be interest-bearing. And in times of heightened uncertainty and crisis, so the safety aspect is more important than the interest aspect, there would be a strong shift towards digital currency and so on. And in order to preclude that, so it would be wise to have the same rate of interest on digital currency as on bank money. Now the next two principles, I'll have no more time to explain those. I simply would say credit to banks should not be should not be the only way, the only channel of issuing digital currency. There are other ways too. Creating digital currency, in a sense, it's genuine seigniorage, and it can be issued in other ways than just by credit to banks or to other financial institutions. And then there is the question of negative interest. It's a very complex matter. I can't discuss it here. But in actual fact, quite a few experts are supporting the introduction of digital currency because they want to impose negative interest, because they say if we could get rid of traditional solid cash and introduce digital currency, then finally we would have an instrument to exercise, so to say, the liquidity preference of the people. So then we could impose negative interest. Personally, I'm very much in opposition to negative interest, but this is a question, it needs to be answered. Yeah, that's the 10 principles on which it depends. And now let me make a last brief remark. And as I said, in modern times, so to say, since 350 years, we have been used to living with that situation of state money and private money side by side. But nevertheless, I think that introducing a digital currency, be it step by step, is a step forward, and coming to a degree with the advantages mentioned today, the advantages digital currency has. And by comparison, the problems inherent to the present near complete rule of bank money, these problems, inherent instability and recurrent crises and so on, these problems are still much bigger than the problems related to digital currency ever might be. That's what I wanted to say. Thank you.